talk about how much they love taxes.
How much they love saving money on taxes. That's what I'm talking about.
That's right.
So let's start. This is March 27th, the industrial cost segregation webinar, and let's get this off the ground. Thank you very much, Brian.
Yeah, absolutely. Absolutely. So, yeah, hey guys, Brian Bigham with Madison Specs. We basically, in a nutshell, we do only one thing and we do one thing really well, and that's tax savings benefiting commercial real estate owners and investors. So, let me ask you, I guess show of hands, like who can see my screen right now?
I
Okay,
got it.
good. Just making sure. That's always one way. I'll just start talking, and then realize that nobody can see what I'm talking about. So that's perfect. Yeah. So again, Madison Specs. We're a division of Madison Commercial Real Estate. We've got a title division, 1031 division, real physical diligence, environmental survey, pretty much everything back office you can think of involving commercial real estate, with the exception of brokerage and management. So I am on the tax side. So basically what we're going to be talking about on this is I'm going to about 15, 20 minutes worth of just talking about depreciation and how it's going to benefit your tax situation. And forgive me, like I love using metaphors pretty much to help. It helps me understand, it helps other people understand. So I use them a lot. So I hope we can all follow along with it. All right. So, first thing, there's my picture. Of course, that was taken in November of last year, and I decided No Shave November should last until all of 2024. So I've got this going right here. All right. So let's get this thing rolling. Let me make sure I've got it going. Okay, perfect. And my screen did change for you guys, correct?
Yep.
Okay, perfect. All right. So ultimately, when you buy a commercial property, or it's not just commercial property, a lot of people, a single family rental home, a condo, all of this is considered commercial real estate. If it's making a dollar of income from rents or leasing or anything like that, it's considered commercial real estate. So when you buy a property, a piece of real estate, you are required by tax law to take depreciation. What depreciation is basically saying is it's a wear and tear of the entire property. So the IRS says that you buy a piece of property, everything on there has a certain life expectancy to it. So right now, we've got two categories. You've got your residential properties, such as multifamily, single families, skilled nursing facilities, things like that, considered residential. They depreciate over 27 and a half years, meaning when you buy the property, you have 27 and a half years of depreciation averaged out year over year over year that you get. For non-residential property like warehouses and retail facilities, self-storage, things like that, depreciates over 39 years. Why these numbers? Nobody knows, but that's what they depreciate over the course of the lifetime.
Boy, this was person.
Okay. All right. So basically, when I'm talking about depreciation, let's give an example. You buy a property for $1 million. All right. You have to take land out of the equation. Land is not depreciable. If a tornado came and knocked a building off, what's left? The land. The land cannot be depreciated whatsoever. So what you do for regular straight line depreciation is you take your $1 million purchase price, take away the land value. Let's say, for instance, this is the average about 15%. That leaves you with the biggest key piece of all of depreciation, your depreciable basis. So in this example, we have $850,000 of depreciable basis. So what that basically means is you're taking $850,000 divided by either 39 for, you know what, I'll tell you what, let's stick with industrial since that's what we're on. You take 850,000 divided by 39, and that gives you that top number, $21,794 a year, every year for the next 39 years of depreciation or losses that you can attribute to the physical property of the commercial real estate. Now, that seems like a big number, right? But what if you have a tenant in there that's paying $10,000 a month? You know, that ultimately you've just in 2 months, you've completely taken away all that depreciation. So overall, it's not enough to cover the expense, the income that you're generating. So you will have to pay your taxes on the income and probably give the IRS a tip, which we don't want. All right. So to give it a kind of a broad example, I've got a cheeseburger situation here. All right. So when you're looking at the left picture, right, it's a cheeseburger with all the fixings and some fries, right? That is your entire property, right? That's everything with all the bells and whistles, the doors, the lighting, the fencing on the outside. Maybe it's got a pool on there, whatever. All right, that's your property. So with the straight line depreciation, you're taking that, dividing it by 39, and taking pieces every single year for 39 years. So with cost segregation, what we're going to do is we're going to do the middle picture. We're going to physically separate and reclass all of the fixings on that property. Things like, let's say the bun, the meat, the cheese, that's all considered your foundation structural component. You know, foundation, windows, walls, roof. In the middle, you've got all the lettuce, onions, tomatoes, pickles, jalapenos. I'm in Texas, so it's jalapenos. That's all of your extra assets like your cabinetry, your appliances, your flooring, your window treatment, ceiling fans. All of that stuff can be separated out from the structure of the building. And I'll even throw in the French fries. Let's say the French fries are exterior land improvements added to the building, like your fencing, your driveway, your parking lots, your parking bollards, gates, anything like that on the outside added, but not part of the structure. The concept of that is we're separating everything out and putting it in its correct life expectancy that the IRS wants. And there's basically three types of asset classes on it. The first one is 5-year property, and I always call that just kind of your interior. It's your tangible property. And that's what I was saying earlier. Your mirrors, your flooring, your ceiling fans, furniture, equipment, if it's an industrial complex, your shelving units, your restroom fixtures, things that are on the inside that are tangible or removable from the property, that's considered 5-year assets. Okay. The second one's your exterior land improvements, 15 years. And that's your fencing, your landscaping, your parking lots, your stormwater system, railings, gates, everything on the outside added to the land, but not part of the structure, is 15-year property. So I'm saying 5-year, I'm throwing all these numbers out there, 5-year, 15-year, 39-year. There's a reason for it. So when we separate and reclassify everything, we're repositioning the depreciation so you can actually accelerate all those tax losses, those tax savings up front. By breaking everything out into shorter time frames, you're getting more bang for your buck the day you buy it and take ownership of that property rather than waiting 30, 40 years for it. So here's the best, a kind of a quick snapshot of what I'm talking about. So the green lines represent what you're doing right now. When you buy a property, that's straight line depreciation. You're taking that purchase price or your depreciable basis and dividing it by 39. You're getting the exact same number across the board for the next 40 years, guys. With cost segregation, what we're going to do is we're going to take all of those 5-year, 15-year assets out, move them to years 1 through 5, 1 through 15. And that's why you get the blue that is consistently much, much higher every single year for at least years 1 through 6. So by doing that, you're doubling, tripling the amount of depreciation losses. You can offset all of the income from this property, potentially offset other income from additional properties. And even more additionally, you can offset your own personal W-2, 1099, whatever income. If you want to tell the IRS how much you made from a garage sale, you can actually use these losses to offset that income. I don't know who would, but just for future reference sake. So that's the benefit. I mean, it's the time value of money. You're getting all of these losses up front to be able to offset or stockpile for future use. These losses are yours instead of waiting 40 years. I don't know how, I don't have too many properties myself that I hold on to for 40 years. I'm a, you buy, you value add to it, you increase it, wait until it's at the top market value, you sell, you buy another property. The idea with this is you have the way to offset all of that income so you're not paying the taxes on the deal. So there's because you have to pay taxes on everything. There's sales tax, there's income tax. When you every year you have to pay taxes on the money you made that were already taxed. This is why I say don't give the IRS a tip, guys. This is a way that the IRS has put in place to be able to help yourself and your investors involved. All right. So cost segregation in a nutshell. So this next one is where it gets kind of fun. Like essentially, I always put this in there. I don't really talk politics too often, but in this industry we have to. So if you ask me anything about politics, I will normally just lie through my teeth and you say, "Who did you vote for?" I voted for Kanye West, whatever. It's how it's going to be. But does anybody here remember this debate when Donald Trump was going up against Hillary Clinton before he was elected president? Basically, she was saying that this man does not pay a dime in federal income taxes. During this debate right here, he actually said, "Well, I use the laws of depreciation that your government puts in place to help real estate owners and investors." Since then, it's like you look around going, okay, well, why can't the American people take advantage of this? Well, I'm saying, why didn't he put his money where his mouth is and help us? Well, by God, he did. So this is when the Tax Cuts and Jobs Act of 2017 came out. And basically, what it is stating is that, with many, many changes to the income tax levels, doubled standard deductions, new limitations on itemized deductions, but one of the biggest key pieces on this was bonus depreciation. Bonus depreciation is cost segregation on steroids. What it's basically stating is that any commercial real estate property purchased with a asset under a 20-year life, which going back is all that 5 and 15 year, that's under 20 years, is eligible to move all of that depreciation into year one, the year you actually purchased or placed a property into service. What that's basically saying is you're going to 10 or 20x the amount of depreciation the year you buy it. If you bought a property, guys, in December 31st of, let's say, 2019, then you can literally, for $1 million, you can take $1 million of depreciation for 2019. It's based on the tax year, not the date. So this is, again, example, just like before, it's just showing you that the green line is all your straight line depreciation across. It's very tiny. That's the closest I could put it all in there. But it's basically showing you that now we're taking all that 5 year, all that 15 year and putting it into year one. So you are maximizing that depreciation. What the key to this is, how to use it is you're taking this depreciation, using what is needed, holding on to the rest and rolling it over year over year over year until it's gone. And then the other key pieces is your investors in the deal. Any investor that has an ownership stake in this property will get a piece of the pie. If they have a 1% interest, they get 1% of that massive amount of depreciation. So on their K1, not only do they get your first returns, they also get a monstrous amount of losses. And they can use it however they can, whatever their CPA decides they want to do with it. But there's a catch. So right now, this bonus depreciation was put into law in 2017 with the intention of you're going to get 100% of that depreciation from 2017 until the end of 2022. And then it starts to phase out 20% year over year. So last year in 2023, any property purchased or placed into service was only eligible for up to 80% depreciation. Now we're in 2024, it dropped 20% again. We're at 60%. Surprisingly, all this is happening during election years. Go figure, right? But the idea with that is the reason why they put a time stamp on it was to boost the economy, was to increase jobs, increase buys and sells. And lo and behold, I don't know if anybody else has noticed this, but if you look at the dates of when everything was starting to go down, at the end of by the end of 2022, buys and sells were at the very highest of the market. Interest rates were extremely low. Lending was outrageously gracious to everybody. Now in 2023, it started to plateau a little bit and then drop. Now we're in 2024. We're very high interest rates. Lending is kind of a nightmare, but it might be a nightmare for everybody, but it's for me personally, I can see it's a nightmare. But now there are talks of actually restarting the 100% bonus depreciation. It passed through the House, and now it's sitting with the Senate, and Senate is sitting on their hands. So, but with that being said, as soon as that law was potentially going to be have this restart, everything stopped, and everything's being projected to go up again. Interest rates are going to go down, lending's going to go up, buys and sells are going to happen. So that's hearsay, politics. Seed said, don't let me talk about politics. I'll talk about it all day. All right, so who should do a cost seg study? Damn near everybody. All right. If you're an individual, you own a property, do it. If you are an LLC, everybody involved in an LLC gets to do it. If you have a corporation, you can do it. I mean, of course, C Corp's a little different, but S Corp's for sure. Estates, trusts, partnerships, you name it, you should do this if you own real estate. Because there's multiple reasons why. If you are considered an active real estate professional or rep, you have the ability to use these massive amounts of losses to offset everything. There is no longer passive gains, passive losses, active gains. None of that means anything. Everything is now active. Active losses, active gains. You can use these losses to offset your active gains. You can use these losses to offset capital gains. You can use these losses for absolutely everything that you're paying in, you have income tax liabilities on. I know we're kind of, I'm always bad on timing, but if anybody has any questions about this, I can walk you through it. Let me go to the next one. There it is. Passive real estate professionals, again, you have the ability to use these losses to offset any passive income gains. So if you have income that you get from a K1, you have losses to offset that income. So on paper, you made no money. That's even though your bank account is looking good, on paper, you have no money from it. Oh, this thing is slowing down on me. There we go. So when's the best time? Anytime. You acquire a property, do cost segregation. After you put a renovation or an improvement into the property, that's added assets. You can do cost segregation again if you've already done it before on just the improvements added. It's a way to have your cake and eat it too, guys. You're putting icing on top of the cake. You're adding more and more assets, more and more value. You're taking more and more losses from that. If it's a new construction, you can do cost seg on it. It's even if you're operating at a loss right from the get-go, keep those losses in your back pocket to use when you need them, when the property is making money. Look back studies. If this is the first time you're ever hearing about cost segregation and you're interested in it, you can still do cost seg on a property you've owned for years. The big thing is, remember, it depreciates over 39 years in the future. So what we're going to do is pull from the future years backwards and offset the current tax year that you're working on. But there's always one piece missing from all of these. And that's when you get a property under contract before you close, that 1, 2, 3, or even 4 month window, that's where you can actually take this cost segregation. And I have this calculator. I am happy to email it to anybody. I'll give you my contact information at the end. Feel free to just email me, say, hey, Brian, can you shoot me over the calculator for the investors?
Brian, if you want to email that to me, I can send it
Oh,
to
sure.
the people on the call.
Perfect. All right. I'll send it to John. You just ask John for it, okay? But ultimately, it's a very simple calculation. But what it's basically doing is you can get a cost segregation estimate from us. We will break it down on the full property, and then based on whatever your investment scenarios are, your lending terms, your splits, if you have LPGP splits involved, I can break that cost segregation down just on an estimate level, and you can use that in whatever marketing you want. You guys can say, hey, these are my returns that I'm going to get for all of my investments, but also here's a plus. These are the losses you're going to get for that investment year one, year two, year three. You're basically telling people, look, I have a tax shelter here that's making money. So I want you guys to invest with me. That's the power of how this can work for you. And then, all right, just a quick case study, just to give you guys an example. This stuff really does work. This property, I met a gentleman at a conference a few years back, and he just purchased a massive 322 unit multifamily property for about 28.5 million. He's been doing straight line depreciation. It was his 8th purchase. That's all he's been doing is straight line depreciation. So by doing that, he would have only gotten about $930,000 a year in depreciation, but he had about 32 investors in this deal. So divide that 32 investors by the 932,000. That's not going to work out too well for him if he's making money hand over fist on that property. So he gave me a shot on cost seg. I ended up finding the land value was worth 10%. So you take that out. We found about 65% was structural. So it's depreciable, but not accelerated. 11% was 15-year property, the exterior. 24% was a 5-year property. Ultimately, we saved him $8.895 million in the first year for that one property. What would you guys rather have? 932,000 or $8.8 million in the first year? Needless to say, he said, hey, Brian, by the way, I have 7 other properties I would like you to take a look at. So after that, it becomes a no-brainer, especially with investors involved. All right, this last one is just this is taken directly from the IRS's cost segregation audit techniques guide. Say that 3 times fast. It's basically saying that there are requirements needing for every cost segregation report. If you're not having these in those reports, you're not doing something right. I tell you what, this cost segregation audit techniques guide, it's a great read. Put it by your bedside table every night. You're out in 5 minutes. Promise you, out like a light. That is it. I tried to go as fast as I could for you.
Wow, Brian, that was great. Thank you so much. Let's open it up to questions.
Sure.
If anyone has questions, it looks like there are a bunch in the chat.
Yep. Sorry, guys. I know I was going really fast. I've done these presentations in some cases for hours on end, just talking. But yeah, this is one of those things where I gave you the meat.
So hey, if anyone wants to either come off their mic, it looks like Trevor's asking a question.
Yeah, sorry, I typed it in the chat, but I happen to be driving a car right now. Great presentation, Brian.
Thank you.
I was just wondering, could you just touch on, so we do accelerated the bonus, cost segregation, all that. How does that affect you on the back end with the sale? Let's say we have a property, we sell it in 5 years. Do they get that back, or what does that look like?
No, absolutely. So that's actually normally I would, if I had a lot more time, I would have like 5 or 6 more slides on that. That is
okay.
Yeah, one of those common misconceptions. A lot of people say, hey, Brian, this sounds too good to be true. What's the catch? Right? So when you go to sell a property, when you go to sell it, you owe a capital gains based on the calculation is based on what you bought it for, the basis versus what you're selling it for, and you owe a gain inside of that. Well, with depreciation, you are lowering your basis because you're taking those losses up front. So when you're lowering that basis, your gains hit is going to be a little bit higher. On the back end, it's called depreciation recapture. And here's one thing I always tell everybody. There's actually a very big myth out there on recapture. And the biggest one is you have to pay back all of the depreciation you took when you sell the property. Completely untrue. You are paying at your ordinary income tax rate. This is actually stated in the IRS cost segregation techniques guide. It states that the max you pay is 25%. If you guys are in like the 43% tax bracket, you do not have to pay that. You pay a max of 25%. Now, here's the cool thing about this is when you are lowering your tax brackets, especially with cost segregation, if you have multiple properties, when you're lowering yourself into a lower tax bracket, this is based on ordinary income tax rates. You have the ability to pay less than 25%. You can pay 16, you can pay 14, you can pay 0 on the sale based on offsetting the losses generated to the sale. I love talking about this. This is something I play with. I've got calculators on this too, which I'll send John. How about that?
Yeah, that
great,
would be
man.
great. That'd be a great
Yeah.
resource to have.
Absolutely.
Thank you.
Awesome. Thanks, Brian.
So I say that
Brian.
Alan Majors, can a passive investor carry the bonus back to previous year's passive income? So you can and you can't. So you can, if you take a depreciation on a property you've owned for a few years, you can take that depreciation now, but the only way to apply it to previous tax years is by amending your previous tax returns. Now, you can use those losses from the past and the future on that one property on your current tax filing dates, but the only way to use it on past is if you amend those tax returns, which is doable. Your CPA might not like you, and don't tell them I sent you, but it is doable. Let's see, Rakesh, can an LP investor who is not a real estate agent claim cost segregation?
I think
Yes.
what Rakesh
Sure.
was asking was a real estate professional, not
Oh, okay.
necessarily a real estate agent. Right, Rakesh?
Say, if can a LP investor who is not a real estate professional?
Yeah,
Yeah.
that's correct. Not a real estate professional.
Yeah, absolutely. So you can an LP investor that's not a rep or real estate professional can take that depreciation, but they're not able to apply it to active income like your W-2 or your 1099 or things like that. They can apply it to their passive income. So if they from their real estate income that they're making, they can apply these losses towards that and offset it and basically show on paper they made no money on their real estate. You can do that, but you
Okay.
can, if you're not qualified as a real estate professional, you cannot apply it to, active income.
So there is a way that everybody can take advantage of a cost segregation.
Oh, sure. I mean, if we had a ton of time, I could tell you little loopholes about it until my face is blue. But I mean, you have the ability to also, even as a passive investor, if you meet a certain threshold with your modified adjusted gross income, you actually do have the ability to use a portion of your losses to offset active income, but you have to meet a lot of thresholds with your tax filing. And again, I'm happy to talk about it for hours, but
Yeah. Any other questions? I have a few questions, Brian.
go for it.
Again, thank you very much. Are you're allowed to roll over the losses of these from year to year, right? So if you get, say, a $500,000 loss this year, and you only use $100,000 of it, you can roll over $400,000 to next year.
Absolutely.
It's not you have to use it this year.
Yeah. So
So
here's,
Go ahead.
I was just going to say here, I'll answer yes, and I'll drop an amazing bomb on you. So the answer is yes. You can roll over whatever is not used to the next year, and you have your structural component. Remember, I said you can accelerate anything under a 20-year life. You still have that 39-year property that's added on top of what you roll over. So no matter what, even if you use it all year one, every year you still get depreciation, not a ton, but still enough. Now, here's a cool thing. Let's say, for instance, you get that up front. Then a year or two later, you sell the property. When you sell the property, any depreciation that you did not use, but you acquired from the years of ownership, you still have after the sale. They're called suspended losses because you had them from the get-go and you sold the property and you didn't use them all. You still have them sitting in your tax filing. So
then
that's a cool deal.
if you owed it back, it would essentially cancel out.
Exactly. So
Brilliant.
it's one of those ways where you can either release it and pay less on the profit of the sale, or you can hold on to it knowing that you're going to have a massive tax situation in the future. And if you have multiple properties, again, you could have the ability to use those other ones to offset the sale and roll over what's left to the future. It's a beautiful concept, this tax strategies out there. And, again, the government's not out to get you. They're here they give you all of these ideas and all of these ways to offset your income levels, but they're not out front and telling you.
That's pretty cool. So really, if you're not a real estate professional and you don't take advantage of these loopholes, so to speak, then I mean it essentially will be sitting in your kitty, your tax kitty, so that when you go and sell the property, you're not going to have to pay and you're not going to be charged, correct?
Absolutely. So but that's only, again, I call them loopholes. They really shouldn't be called loopholes, but it's the best way to describe it. Everything is that I'm telling you is completely legal. Let me make sure that's clear. These are strategies that are in place for us to do this. The key is the only way to be able to do that is if you qualify as an active real estate professional. It wouldn't work otherwise. I see there's a question from Sanjeev about the loophole on how to take cost seg if you're not a real estate professional. So actually, I've got my screen up right now. I can show that to you. Let's see. Okay, there you go. This is it right here. This is always talked about, like, how if we're passive investors, how can we take advantage of it in different ways? Well, one of the big ones is if you have a modified adjusted gross income of $100,000 or less, and this is also ways of there's so many different ways of making that happen. If you qualify, if you don't qualify as an active real estate professional and your Magi is actually less than $100,000, you can use these passive losses to offset up to $25,000 of active gains. So this is always one of those times where I say, please consult your CPA because some of them would recommend, some of them don't. I can tell you right now that I love using this across the board, but that's because I know what my personal taxable situation is. But everybody's got a different tax situation. So consult with your CPA and make sure they are real estate savvy, guys.
What before you move on from this, Brian, what if your gross income is over $100,000? Does that mean
if it's
this
over
is
$100,000, it becomes more in the weeds, more complicated. It's
Okay.
more and less about time. How much time you actually put into your ventures, like your real estate ventures. The more time you put into your real estate income and management, maintenance, qualifications, all of that is how you from this stage, how you're going to achieve active real estate professional status. So again, there's so many ways into it, but that's just one of the biggest ones.
Awesome. It looks like Joe Lou has a question, and then
Okay, let's see. How about a 1031 exchange? How does that impact appreciation? Well, there's two ways of answering that question, because I'm assuming one of them is right and the other one is you didn't know about it. First one is when you go to sell the property, the way to completely basically not pay the taxes, the gains, the recapture, whatever, is to do a 1031 exchange out of the property. What that means is you're taking all the profit, every penny of it, and moving it in a small time window, moving it to a new property, whether it's a down payment or maybe multiple single family rentals. It doesn't make any difference. Like kind exchange means income producing property to income producing property. You are basically kicking the can down the road on paying the taxes owed on the property you're selling. Now, that's the way of selling it. Now, let's say, for instance, you're talking about doing cost segregation on the property that you are 1031 exchanging into. You can still do cost segregation. What you're basically going to do on the new property is take the purchase price and calculate how much 1031 exchange money that you're putting into it. It's going to be lower than the purchase price, obviously, but it's going to be higher than the 1031 basis you're moving. Then you can do cost segregation on that amount. And it's a whole new ballgame, a whole new property, whole new, calculations, everything. So I hope that answers one of your questions.
Awesome.
Okay, good.
Thanks, Brian. Well, we should be cognizant of your time. Thanks again, Brian.
Absolutely.
Thank you for joining us. We did just do a cost seg study with Brian on our North Carolina asset that we paid $2.2 million on the acquisition. We raised about we're raising about $900,000, and we got over a $550,000 cost seg study. So incredible, lots of depreciation for that to give out, and that's for 2023 losses. So thanks again. If you're interested in that deal, feel free to reach out. Let's stop the recording here. So thank you for everyone joining.
Thanks, John.